Okay, hello everybody. Welcome to Korean Atlanta Mentorship. And I'm going to show you, as a cash flow doctor, not a medical doctor, how easy it is to pay off your med school debt. Okay? I'm not a real doctor, never went to med school, but as a cash flow doctor, I'll show you that today with Velocity Banking. So I asked ChatGPT here, come up with a typical income and debt schedule for a doctor. And so basically, let's say we make 400,000 a year, then our net income is about 280,000, which means we make about 23,000 a month after tax. And then we can also see here that these are typical debts that a doctor would have, and we only have four debts. And this is a lot easier than most people would expect, because when people deal with medical school debt, they kind of freak out, right? Like, $250,000 for 10 years. Oh my gosh, how am I going to pay it off? But let's do it with Velocity Banking. So what is Velocity Banking? All it is a debt payoff strategy where you throw all of your money into debt with the help of something called a line of credit. Okay, so if you take a look here, our income is 23,000 a month. We have expenses of 11 grand a month, and if you take a look at our expense breakdown, we have $5,000 in expenses that are not debt. So things like food, gas, insurance, that we'll say is about 5,000 a month, and then all of our other expenses are our debt, right? So most important thing is that we list every single debt that we have in our budget, because we're going to go ahead and pay it off. Okay, so with Velocity Banking, we assume we have the same income and the same expenses, but the first psychological hurdle that you will have as a member of society, not just as a doctor, is the urge to save money. Okay, that's like the first psychological hurdle that you are going to have to surpass. So what that means is that this is essentially going to be zero, right? So the checking and savings is going to be almost zero at the end of every single month, and a lot of people are scared of that. So what's the difference between here and here? So even though here we're doing pretty well, okay, we're doing pretty well, this might be a big psychological jump to most people. And really the main difference between here and here is the checking account the final destination of your money, or is essentially a middleman, right? Here we treat this as a middleman, meaning, let me just kind of show you right here, if money comes in, it just goes right out. Now, where does it go to? It goes to something called a line of credit. Now, if you're a doctor, you probably have a very easy chance getting a line of credit compared to most people. So this is my little humble $373,500 home equity line of credit. Home equity line of credit. So what does that mean? I can just click a button on the bank's website, and then they'll dump up to $373,500 into my checking account. Pretty much no questions asked, right? It's just like a click of a button. Okay? And so what we're going to focus on is this number called cash flow, right? Which looks the same as the checking and savings, right? It looks the same in the beginning, but very important concept that we have to understand is that the reason why we separate the checking and savings from the cash flow here is that we're not going to save money. So in traditional banking, having money in your checking and savings is considered to be cash flow, whereas Velocity Banking, we don't treat it that way, right? It's like one of the I don't know, 10 commandments of Velocity Banking. So we're also going to assume now, as a doctor, if we have $12,000 a month in our checking and savings, we can easily get a line of credit. Easy. That's absolutely no problem, right? So one of the types of lines of credit that you may not be aware of is also a personal lines of credit. I've heard of physicians lines of credit, but all it is regardless of the name, it's just you can easily pull money and put it back, right? Pull money and put it back. And a credit card is technically a line of credit as well, although it has some restrictions. And if you want to know about me, I have over $739,000 in lines of credit. $739,000 in lines of credit. So you see all these credit cards, personal lines, credit cards, credit cards, credit cards, home equity line. Now, here's the secret, and here's why if you're a doctor, you can easily get a line of credit, okay? Almost 90% guarantee, okay? Because banks don't lend money to people who need it. They don't lend money to people who need it. So if you're a doctor right? You got $12,000 coming in your checking and savings each month after all expenses paid. People will see that, or the banks will see that as like, whoa, I got to lend to this person because you're essentially a safe bet. Okay. Now, as someone who's a high paying professional, you're the bank's favorite target because what they hope is that because you make so much money, that you're going to be attracted to many, many small payments over time, right? So, as you can see in this example, we only have one credit card, but in previous examples, I've seen as much as like, 10 to 20, right? I personally have, I think, like 22 credit cards, and I know how to manage them, so this is not an issue. But the hope that of any financial institution is that you make good money and eventually you'll have so many debts that this checking and savings goes to zero, right? So let's just assume for now, as it may be a doctor, we have 300,000. We can easily get a $300,000 home equity line of credit. We have a home. We see you have a mortgage right here, 400,000. But if you bought it at the right time, let's say in like 2019 or 2020, your home probably appreciated like 300,000, right? So you might have good equity there. So what we're going to do, okay, is move some of our debts into the line of credit and then just simply dump all of our money in and then take our expenses out and then rinse and repeat over and over again, right? So it's going to be a relatively simple process. So how do we know what debts to move into the line of credit? Well, it's relatively easy, and this is going to be super easy. I like to show velocity banking when the checking and savings is like near zero, but this is going to be really easy, okay? So what we do tend to do is we have this thing called the cash flow index, which is a formula of the balance of the debt divided by the payment, right? And so we're going to go ahead and do that. So 40,000 divided by 754.85. And then this one right here is 50. Oh, no. Let me just kind of go back here. Is 250,000. My bad. 250,000. That's the debt. Okay, let me just change this. 250. And then this is 6.8%. Okay, and then let me just do the formula here. So 250,000 divided by 2877.01, and then this one is 400,000 divided by 2398.2. So what does this cash flow index mean? Basically, the lower the number, okay, the more bang you get for your buck in terms of cash flow when you move some debt into the line of credit. All right. And so, why do we not want to pay off the high numbers first? Well, basically, I essentially have to give $400,000 to somebody and only to get 2,400 back in my cash flow. Whereas on the other hand, I could give $250,000 to get more than that, right? And then so it's all about ratio bang for your buck. So what we're going to do, okay, is just move some debt, and I'm going to make this really easy. Let's just move the credit card and the auto debt together, 45,000, okay, and then move it into the line of credit. So what happens when we move that into the line of credit? Well, this was what happens. These payments go to zero, and so our cash flow increases, and then we'll see how easy it is to pay it off. So the final step is what we're going to do is put our entire paycheck into the line of credit, take our expenses out, and then rinse and repeat over and over again, right? So 13 grand of cash flow is essentially the amount that our debt gets reduced. So let's go ahead and do this. So we get the previous month's balance, previous month's interest minus our cash flow, and then the interest of a line of credit. And then I'm kind of going a little bit fast here. Is based on the average daily balance. So you take the interest rate divided by 12. Okay. And then what we're going to do is I'm just going to copy and paste, right? So you see that now the credit card and the auto loan was paid off in about 4 months. Okay. Wow, that was really easy. Okay, so 4 months, and I'll be right. So that's 45K done. Whoopsie, done. Okay. And so now we have the student loan, we have the mortgage, and so we just follow the cash flow index. And then here, I have a special loan calculator here. Um, Actually, this one was paid off, so we don't have to worry about the auto loan right now. So this one should be zero. So we just already moved that one to the line of credit. But if we use this calculator here and type in we're at the 4th month, it does the amortization formulas, and you can see that this is the current balance, and then we just have to use the I'm sorry, we could just use the cash flow index to figure out which ones pay off. So now, really, this is really simple. We only have 2 debts, and we should focus on the student loan first because it gives us more bang for our buck in terms of cash flow. And we can also see it as a higher interest rate. Now, is it a good idea to move this entire thing into a line of credit? The answer to that is usually not, especially if there's an interest rate difference, and I'll go over that in a later video. But I just want to show you that when we're dealing with big amortized loans and small payments, we have an easy way to pay it off, something called chunking, right? So what we're going to do is just move pieces of the loan into the line of credit. So what I'm going to do, okay, is I'm going to move 25 grand of the loan into the line of credit. So this is how it would look like in real life. So remember, the cash flow only increases once we pay off the entire thing. So the cash flow will stay the same. But let's say we move a piece of loan into line of credit, that 25 grand gets paid off in like 2 months, right? And then we just rinse and repeat over and over again, and you see how easily you're paying off the 25 grand, and look at the little how little interest is accrued. Easy way to pay it off, right? So you're just moving all of your money to pay it off debt, making it easy for you. And we're at the student loan phase right now, so we're only at the actually we're at the 11-minute mark. I was hoping to do this quicker, but we're at 23 grand, and we'll look how easy we're paying off the 25. So now luckily I have this Velocity Banking calculator here, and what we do is we can just type up the details of the loan, and if we're going to do, let's say, a chunk amount of 25,000, all we got to do is type in the income, expense, and the loan amount, and we can easily figure out how much time it's going to take to pay off that loan. So this is just kind of my cheat sheet here. So let me just kind of put the income 23,333, and then the living expenses is everything except for the loan you're trying to pay off. So we're trying to pay off the student loan. So what we do is we just sum these numbers up. Whoopsie, what happened here? Let me go ahead and do this again. All right. And so that sum of that is 7398.2. So 7398.2. And then what's the current loan information of that student loan right here? So original balance is 250,000. So 250,000. And then this is 244,108.79, 244,108.79. And then 6.9% interest rate. Usually this is 10 years, right? So 10-year loan. And the payment amount is 2877.01. 2877.01. And then we see that it gets paid off in 1.4 years, right? Right? So doesn't that match the title of the thumbnail? My med school loans were so easy to pay off, 1.4 years, right? All you have to do is deal with the credit card and the auto loan first. But yeah, so not a big deal, if yeah. So I have many family and friends who are doctors, and I wonder how much this would benefit them, but I don't talk to them much nowadays. So now this is going to be 0, and now let's go back here. So if it's 1.4 years, so that would be 4 plus 1.4 times 12, and then that's going to be 21 months. All right, and then, all right, so 21 months, 45 plus 250. So that would be 295K, right? 295K. And then, all right, so now we just do the same thing with the mortgage, right? So where are we at with the mortgage? We're at month 21. This is now 0. I just kind of do the chunking over and over again. And here's a cool thing. A lot of people are so sensitive to interest rates. Yes, the interest rate does matter, but not as much as you think it would, right? So even if I use it to pay off a 30% credit card, now I'm not saying you should do that, but what I'm saying is that it's not as important as much as you think it is, right? A lot of people have this crazy fear, like, oh my goodness, I'm using an 8% line of credit to pay off a 6% interest rate. But let me just kind of show you again. So now we're going to have to modify some things. So this is going to now be a 36% 30-year mortgage, and the payment amount of that mortgage is 2398.2. So 2398.2, and then the original balance is 400,000. Okay, and then now we have to modify the expenses because the expenses is now only 5,000, right? So only $5,000 because we include everything except for the loan we're trying to pay off, because this is calculated here. So 5000, and then what is our current balance? Okay, I'm going to show you the current balance here. So the current balance is 391,206.1. So 391,206.1. And then we see right here, this is paid off in 1.9 years. Paying off a mortgage in 1.9 years. Wow. You know, I paid off mine off in 2 years and 9 months. And if you don't believe me, this is my proof that I paid off my mortgage in 2 years and 9 months. But 1.9 years, folks, if you're a doctor, you have so much potential to get out of this debt, right? So this is 1.9 years. That's crazy. That is crazy. So now this is going to be 0, and then it's going to be 21 divided by 12 plus 1.9. So that's going to be 3.65 years. We're completely debt free, and that was so easy, and we were able to live our expenses or our normal lifestyle. So you know how it's like we got a budget, but like, I mean, on average $5,000 a month is kind of a lot just for expenses, right? Unless you're like eating out and clubbing or drinking every single night at the bar. $5,000 is just way more than enough. Okay, and then you can see then 3.65 years without necessarily making more money, we went from 12 to 18 grand, right? And now we can go ahead and save the 18 grand per month in our savings because all of our debt is paid off, right? And all it took was 3.65 years. 3.65 years. Oh my goodness. Okay. All right. So, yeah. So I think what I'm going to do, and I don't know if this is 100% certain yet, is I might just create another YouTube channel, right? Just to target towards medical professionals, because the first time I showed this to a nurse, I remember she was like shocked, right? She was shocked about when I showed her this because she actually had to sell her primary residence and move into her rental property residence because she couldn't make the payments work, and she was making, I think her household family income was at least more than 200,000 a year, right? So, okay. All right. Okay, well, that's it for today, folks. This is Karina Lanta Mentorship here with another video. You know, I think I am a doctor, not a medical one, but a cash flow doctor, right? So if you made it all the way to the end of the video, type in cash flow doctor in the comments below. Let me know you watched the end of the video, okay? Have a great day, and I'll see you on the next one.